Hello everyone, welcome to a word from Devil on Techno Fundamental Investing. My name is Nrupen and in this video I would like to give you a little basic level information about fundamental analysis. First of all, what is fundamental analysis? Well, fundamental analysis is a way of measuring financial health of business. While fundamental investing, we evaluate financial security. The evaluation of financial security can be based on intrinsic value, market value, economic factors, qualitative and quantitative factors, or all of them. Intrinsic value of stock is expected value of business in its lifetime with respect to now. Note that intrinsic value can be calculated via several different methods. Depending on method of analysis, it varies and it can never be a precise number but an estimate. Economic factors are market conditions that usually forces anyone to change their spending habits. For example, if tomorrow price of milk goes up by 100 rupees, it will change how people spend money on it. Economic factors are not under anyone's control and they can change without any notice. For a business, economic factor may include labor cost, interest rate, government policy, taxes, etc. An occurrence of economic factor may trigger upside in stock prices of a business. My method of fundamental analysis works on economic cycle of business and thus focuses more on business's ability to complete its economic cycle if economic factor triggers upside. Qualitative analysis is non-mathematical way to scrutinize financial security for investment. It mostly involves judging business and its management for their work, ethics, and ability to deliver results. Qualitative analysis requires good amount of knowledge and experience about how different businesses work and operate differently. It is usually not a cup of tea of an average investor who have no background in business management. Qualitative analysis provides edge to people who can understand how business and financial market works. It is not easy to master even for the people who have educational qualification for business management. Qualitative analysis refers to trying to predict future financial situation based on mathematical measurements, calculations, statistical model, and numerical research. It deals with taking a look on balance sheet, profit statement, cash flow statement, etc. All ratios and numbers can be classified into quantitative analysis. When you look for fundamental analysis in hope that someone will give you exact things to look like low PE, low book value, debt, etc., you aren't really looking for fundamental analysis, you are looking for cheap tricks. The answer by no means can be that simple. In majority of my videos, I have said it time and time again, while fundamental analysis, we just match a theory of what is a successful business to its financial traits. Now, as per the definition that I gave you of fundamental investing, investors analyze stocks based on economic factors which may or may not include both traditional and behavior economic conditions, calculation of intrinsic value, market value, and finally qualitative and quantitative evaluations. Problem is most of the factors that we have to evaluate for fundamental analysis are educational disciplines all in themselves. You cannot master all of them. Therefore, we need a theory of what is successful business and what can be its financial traits. Then we match what is theoretically a strong business to its financial traits to get fundamentally strong stocks. For example, Benjamin Graham devised an analysis method in which he would quantitatively analyze businesses' financial and market value against each other to determine intrinsic value. Theory behind this method of analysis was a successful business always earns more than what it requires to stay in business. Graham's method was mostly quantitative in nature. Keep in mind, all quantitative numbers, which even means PE, are relative numbers. So unless you know with respect to what you are looking at PE, you cannot have any idea is PE really low or not. A PE of 40 can also be a low PE. Peter Lynch had master's degree in business administration. For him, successful businesses' products are popular or are in high demand in market. His method of fundamental analysis revolved around business' ability to cash on its popularity. Warren Buffett looks for quantitatively as well as qualitatively good business. For him, qualitative look over business is more important than quantitative look. His method, though inspired by Benjamin Graham, differs a lot in terms of qualitative and quantitative levels. Jeffress and Villanelle method were more of dependent on expansion plans of business, and majority of businesses they bought were already trading at a very high PE, and they still made fortune out of it and became legends of Wall Street. Bill Miller was honors in field of economics, and he was the first person to introduce use of traditional as well as behavior economics to field of investing. His method involved looking at economic factors and future prospects that can support growth of business in future. He could buy all kinds of value stocks, either it be trading below book value, 5 to 10 times of book value, and even turn around stocks. His 15-year consistent market beating streak at Lake Mansion is legend in itself. I have very high level respect for Peter Lynch, Villanelle and Bill Miller because to a great extent the way I find stocks and plan my investments are derivative of their work. I have met people who claim method of Peter Lynch and Villanelle are outdated and they no longer work. Again, that is lie. Problem you have is you are trying to find stocks totally based on mathematical face value explained in their books. You have to understand no matter which author you pick to read, there are very rare chance of 100% match to all criteria. You have to understand core idea of investing methodology so that you can find close matches while selecting stocks. For example, I was at Hindustan Petroleum's petrol pump and there came a big petrol delivery tanker. Apart from HP logo, there was something else written on it, and it was Agarwal Industrial Corporation. That rang bell. Why an HP tanker have Agarwal Industrial Corporation written on it? It was listed on both BSE and NSE. I went to their website and found they don't only supply petrol but also LPG and other flammable chemicals. And their clientele includes Hindustan Petroleum, Bharat Petroleum and even Indian Oils. After checking fundamentals, I found the business has performed very good for last 4 years and is also generating more income than what it needs to survive. The stock matched Benjamin Graham's base investing ideology since it was also trading below its book value. Next, having clientele like Hindustan Petroleum, Bharat Petroleum and Indian Oil made it very clear their services are gaining popularity among their customers. So I didn't only found about stock with Peter Lynch's method, but the stock also matched his investing ideology. On September 2016, its stock broke resistance to create fresh 52-week high, thus by ideologically matching Villanelle's investing methodology. The fresh 52-week high was also economic trigger for Agarwal Industrial Corporation, and as per its balance sheet and profit statement, it was clear the economic cycle for business has begun. Now since economic cycle was triggered, I bought it there for 237, and as you can see, it moved like 3 folds from buying point. Similarly, when I went for servicing, I found about Rico Auto. My friend was decorating his car. That's how I found about Harita Seeds. The problem is not in method of any investor to find and invest in stocks. The problem is how alert you are to pick stocks when stock makes its presence felt. I have tried every investing method of every book I have read so far, and I didn't find a book whose method didn't work. The reason I personally rate Peter Lynch above majority of value investors is that his method of finding stocks while buying products have produced result with extremely high profits as compared to other methods I have tried so far. And if you still think you must tell someone Peter Lynch's work do not work, then tell it to someone who bought Amara Raja batteries, Aicha Motors and Bosch. They would be the happiest person to agree with you. In an interview with NDTV Profit of 2011, the Badshah of Dalal Street, Rakesh Jhunjhunwala himself also recommended One Up on Wall Street as best value investing guide for someone with no background in business management, and how it helped him pick some of the best stocks of his portfolio. New investors might think why majority who give their opinion on investing are biased toward Peter Lynch and William O'Neill. There are 2 reasons for that. First, these are guides that help many investors pocket their first profitable stock. Second, stocks picked with Lynch's method usually end up with massive multi-bagger gains. Keep in mind, you are not supposed to look for numerical values without having any idea why looking for them is important. While looking for stock based on economic trigger like ratios, P, ROE, EBITDA are not required. Not even looking at cash flow statement is important. Important factors are fresh 52-week high as a result of any type of current economic trigger and balance sheet profit statement strong enough to let upside continue caused due to economic trigger. I don't look for traditional ratios because buying on current economic trigger doesn't require you to look for them. Same also applies to those investors who prefer only turnaround investing. The stocks they pick by traditional look will appear unsuitable for investing. This does not mean turnaround investors pick stocks only to make losses. They have their theory of how a turnaround business can again become a successful business. Based on that theory, financial traits of business are compared and high probability turnaround is bought. Next thing to keep in mind is that not all of your stocks can become blockbusters. For every 10 stocks you will buy, only 2 or 3 will become blockbusters. Some might totally fail to perform and rest might not perform as your expectation. There are 3 steps in investing process: analysis, risk management and strategy. Analysis is just probability and it can be wrong. Therefore, we have risk management. Risk management is required so that we can cut stocks that fail to perform before they turn into big losses. After cutting failures to turn into losses, you are supposed to focus on your blockbuster stocks for multiplying your profits. You need risk management and strategy because no matter how good you are, there is practically no chance you will ever have 100% success rate. My friends usually get shocked to see how all stocks in my portfolio seem to be performing, but I always keep telling them 100% success is not possible. Well, the answer lies in risk management. I have very strict rules to book losses on my purchased stocks. As soon as stock matches that criteria, I release it without any second thought. This surely led me to selling some of the good stocks very soon, but I haven't made a loss since the released money got invested in other stocks and there I made profit. And the reason why stocks that I buy appear to be performing as soon as I buy them is because theoretically I buy on economic trigger resulting in 52-week high. In general, I buy stocks that are already high and most likely to keep going higher. A strong selling rule is important for an investing method that focuses on buying a stock on its 52-week high. Without strict risk management, such investing methodology is a recipe to go broke as soon as possible. When you are looking for strict mathematical conditions for fundamental analysis, you are looking for answer to wrong question. A wrong question will always get you wrong answer. For investing on fundamentals of business, you must have an idea on which theoretical model it could be called a fundamentally strong business, what risk management would be good to go with, and how you can strategically multiply profits with it. Even if you are planning to clone stocks from well-known investors, you must have a little idea on their investing methodology. For example, I clone Vijay Kedia. What I know about his investing ideology is that he picks high conviction stocks with proven track record of performance. He usually buys when there are high chances of price volatility to settle down for some time. Majority of his stocks are high PE stocks as traditional means of PE calculation, but low PE as compared to future earnings of business. For example, take his stock pick of Vaibhav Global right now above PE of 35. By all traditional methods, it might appear it is high PE expensive stock. But if we take an overall look, Vaibhav Global was consistent performer since 2010. The consistent performance doesn't mean guaranteed profits, but it makes it good enough to be rated as high conviction stock. Volatility settled down maybe on July of last year. On April of this year, Vijay Kedia initiated his buy position on this stock. All high conviction stocks are usually good for concentrated portfolio and usually deliver results with buy and wait for high mentality. The selling rules that I apply on my picks are not supposed to work on stocks selected by him. I have to come up with risk management and strategy suitable for concentrated portfolio. Cloning is a lazy way of investing, but still it requires you to understand how the person you are cloning invests because losses are inevitable. Your favorite investors know it and they do release their position when stock matches their selling criteria and you end up in losses for being just too lazy. Investing is experience-based subject and you become better only with time. You suffer loss and then you have to give time to figure out how you could have avoided that loss, and it leads to better risk management. Next, do not take investing psychology as unnecessary chapters. For example, investors who blindly pick stocks that look fundamentally good just based on ratios without having any idea why the numbers and ratios they are looking for are important usually end up in losses. The investor psychology is better known as value illusion, which usually results in investors picking worthless stocks under impression of picking a value stock. The term was coined and made famous by Bill Miller. Next is economic moat. It refers to that ability of business which provide business competitive advantage over its competitors to maintain its long-term profits. Most investors usually take moat as low-cost producer. Though low cost of manufacture can be considered as moat, moat doesn't actually mean low cost. It means something a business can brag about. For example, one of the products that business manufactures ends up getting product of year 3 times in a row. That too can act as moat because business can brag about it. Any new customer who would be interested in buying product will prefer them against their competitor because the label of 3 times product of year will automatically induce an idea in buyer that their product is better than competitor. The label of 3 times product of year will for sure provide business competitive advantage over their competitors. So remember, moat is something which makes harder for any competition to take share of business in long term. It is something about which a business can brag of. It can be product quality, low cost, salesmanship, public reputation, and list can go on. Just remember 2 things about moat. First, it provides business long-term advantage over its competition. And second, it is something a business can brag about. The term was coined and popularized by Warren Buffett himself. Moat is the reason why Warren Buffett always bought shares of Coca-Cola during its great decline during economic crash. Next is myopic loss aversion. This is tendency of investor due to which they keep holding stocks in spite of it matching all their sell criteria. This usually result in people holding their losses and let the minor losses become big, and not selling their position in hope of more profits, thus not booking profit and let profit turn into losses. Myopic loss aversion is standard term used in behavior economics and was coined and made popular by Richard Thaler, Amos Tversky, Daniel Kahneman, and Alan Schwartz. Similarly, exposure effect buying is also dangerous. Exposure effect makes you biased towards business just because name of business is easy to spell, catchy, or unconsciously familiar. The best example of exposure effect is Theranos. It is California-based blood testing company. Theranos promoted a small volume blood testing program that was practically impossible with respect to current technological standards. But still, business raised over $400 million and was evaluated to be $9 billion in net worth. Investor fell victim to exposure effect by cool sounding name Theranos. Apart from that, the CEO of business Elizabeth Holmes promoted herself as Steve Jobs of blood testing technology, which added to exposure effect. As a result, investors are now suing it for fraud. The word Theranos, Elizabeth, and Holmes created exposure effect because of their familiarity with popular pop culture names, and investors were fooled into believing in an impossible product. The term was coined by Robert Zazonik, and effects of exposure effect were also found in study in Switzerland, where they found how fluent names like IMI, Swiss First, and Comet were most preferred by stock against businesses like Jaberit and Jobson because of exposure effect. In One Up on Wall Street, Peter Lynch described same as good businesses usually have uninteresting names and they perform uninteresting jobs. As example, he tells about how investors were disgusted with name of solid waste management and decided to shun it without realizing a solid waste management business is least likely to go out of business and requires minimum management skills. As I will get time, I will try to create videos on investing styles of investors, whose books I have read so far. I will try to keep forward their theoretical model of successful business and how they would match financial trade to find good stocks along with their risk management method and strategy. But you have to understand there is no cheap trick to investing, and the videos you watch on YouTube, either I create them or anyone else, are no match to information that you can get from books. Reason is investing requires experience. You will make mistake, that's inevitable. You just can't avoid them. You have to scan whichever book you are referring to find answer to how you would have avoided your mistakes. As everyone, I would definitely recommend One Upon Wall Street by Peter Lynch and How to Make Money in Stocks, a Complete Investing System by William O'Neill. If you prefer buying from Amazon India, then I have also provided links in description of video. In case you like any other investor, you can buy their books, but don't live with an idea you will understand it just by reading. Understanding of investing method will only happen after you will start applying it. Sorry to tell you, I can say all I want that just watch my videos and you will be investing successfully, but no amount of brag is going to make it true. You simply can't learn experience-based subject just by watching a 10 or 20-minute video. There is no match for real effort. Thanks for watching this video and have a nice day.